Hey everyone, welcome back to Corporate Decoder, the place where we decode the financial statements of the biggest companies so you don't have to. Today we are diving deep into Dine Brands Global, the parent company of IHOP and Applebee's, and let me tell you, their latest financial report for the second quarter of 2025 reads like a blockbuster movie with more twists and turns than a roller coaster. Before we get into the nitty-gritty, if you appreciate getting straight insights from corporate documents, make sure you're subscribed. We also have a Discord community linked in the description below where we discuss these filings in even more detail. So Dine Brands Global filed their quarterly report, otherwise known as a 10Q, the document that gives us a peek under the hood of how the company is doing financially. It covers the period ending June 30th, 2025, and it's packed with numbers that tell a really interesting story. Let's kick things off with a look at their balance sheet. This is like a snapshot of the company's financial health on a specific day. We see their total assets are pretty much flat year over year, sitting around $1.8 billion. That might sound like a lot, but when you look at their liabilities, which are basically what they owe to others, they total just over $20. This means they have more debt than assets, which is something we always keep an eye on. Now for a key figure affecting shareholder value, their common stock situation. As of June 30th, 2025, they had about 15.4 million shares outstanding compared to 15.3 million at the end of last year. This slight increase could be from stock options or awards being exercised, and it's generally good to see the number of shares outstanding hovering around this level. Now let's talk about the income statement. This is where we see how much money they raked in and what it cost them to do business. For the second quarter of 2025, total revenues were $230.8 million in 2024. That's a nearly 8% increase in revenues. However, the story gets a bit more complicated when we look at net income. For the second quarter of 2025, net income was $13.8 million. That's a significant drop from $23.2 million in the second quarter of 2024. Essentially, they made about 40% less profit. Looking at the first half of the year, net income also took a hit, falling to $22 million in 2025. From $40.7 million in 2024, that's a staggering drop of almost 46%. So while they are selling more, the company is becoming far less profitable. A big reason for this profit drop is that loss on extinguishment of debt. In the second quarter of 2025, they had a $0.9 million loss related to paying off some old debt. For the first half of the year, this loss was also $0.9 million. This shows they are actively managing their debt, but it's impacting their bottom line. Another big factor impacting profitability is closure and impairment charges. In the second quarter of 2025, these charges jumped from $0.4 million to $1.2 million. For the first half of the year, the increase was even more dramatic, going from $1.1 million in 2024 to a hefty $7 million in 2025. This suggests they wrote off a lot of assets or closed down operations, which eats into profits. Let's break down the revenue by business segment, franchise operations, which is pretty much where they get their royalty and advertising fees from, are seeing a slight decrease. For the second quarter, franchise revenues were $74.7 million, down from $76.5 million in last year's quarter. That's a small dip of about 1%. For the first half of the year, franchise revenues are down by about 3%. But here's where it gets interesting. Applebee's same restaurant sales, which means how well the restaurants open at least a year are performing, actually increased. For the second quarter, domestic same restaurant sales were up 4.9%, and for the first half of the year they were up 1.3%. This is positive news, showing that customer traffic and average checks are going up at Applebee's locations. Scroll Hop domestic same restaurant sales percentage change, Ginskaba Hop, on the other hand, is struggling. Their domestic same restaurant sales decreased by 2.3% for the second quarter and 2.5% for the first half of the year. This means fewer customers are going to IHOP, so they are spending less when they do go. And it's not just us saying this. Industry data shows IHOP is underperforming the family dining segment of the restaurant business. Fuzzy's Taco Shop is also having a rough time. Their domestic same restaurant sales dropped by 11.8% in the second quarter and 12% in the first half. This is a significant decline, indicating major challenges for this brand. And this trouble at IHOP and Fuzzy's is reflected in their franchise numbers. They saw a net reduction of 21 franchise restaurants for Applebee's and 18 for IHOP in the second quarter alone. This means more restaurants are closing than opening under the franchise model. Now let's look at company-owned restaurants. This is where the company directly operates restaurants. Their company restaurant sales have surged dramatically. In the second quarter of 2025, they reported 25, they reported 25, it reported 25, they reported 25, it's 49.8 million compared to only $600,000 in 2024. This huge increase is because they acquired a lot of IHOP and Applebee's locations in the past year. This acquisition spree significantly boosted their total revenue as we saw earlier, but unfortunately it didn't translate to higher profits. The company restaurant segment actually operated at a loss of $2.7 million in the first half. This isn't too surprising as integrating and turning around acquired businesses can be costly and take time. General and administrative expenses also went up. For the second quarter, they increased by about 8%, and for the first half by about 3%. This rise is attributed to higher compensation costs, professional fees, and expenses related to integrating the newly acquired restaurants and their ongoing dual brand and remodel initiatives. Looking at the debt side of things, Dine Brands Global has been busy refinancing their loans. They have two main types of debt outstanding, the Series 2023 and Series 2023. And Series 2023 and Series 2025 fixed rate senior secured notes, as well as a variable funding credit facility. In June, after the end of the quarter, they made a significant move by repaying their 2019 Class A20 notes. This was a big debt repayment that incurred a loss on extinguishment of debt as mentioned earlier. They also established a new credit facility in June, allowing them to borrow up to $325 million. As of June 30th, 2025, they had already borrowed $100 million on this facility. This shows they are actively managing their credit situation and have access to more funds if needed. It's worth noting that as of July 24th, 2025, the company had about 15.4 million shares outstanding. This is a key number for understanding share-based metrics and ownership. So what's the overall picture here? Dine Brands Global is in a period of significant transition. They are buying up franchise locations, which boosts revenue but hurts short-term profitability due to integration costs and refranchising efforts. While IHOP and Fuzzy's are facing serious headwinds with declining sales, Applebee's seems to be holding its own and even showing some domestic same restaurant sales growth. The increase in debt-related expenses and operating costs is a concern and is impacting their net income significantly. They also reported adjusted free cash flow, which is a measure of how much cash they have left after essential investments. For the first half of 2025, it was $48.7 million, which is actually down from 2024's 52, down from 2024's 52.9 million. This decrease, coupled with the declining profitability, suggests that while they are growing revenue through acquisitions, they might be sacrificing efficiency and profitability in the process. Now, looking at these results more broadly, Dine Brands Global appears to be in a challenging but interesting phase. They are investing heavily in acquiring company-owned restaurants, which is a big bet on their ability to directly manage and improve operations, especially at IHOP locations that are underperforming. The strategy with Applebee's seems to be working better with those same restaurant sales figures showing resilience. However, the significant drop in net income and the increase in operational costs highlight the risks associated with this aggressive growth strategy. They need to prove they can efficiently manage these new company-owned locations and turn around the struggling IHOP brand to justify these investments. The overall debt levels also remain a point of vigilance. Alright, that's our breakdown of Dine Brands Global's latest filing. What's your take on these numbers and what they signal for the company's future? Do you think their acquisition strategy will pay off, or are the declining profits too concerning? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.